Hello everybody, Craig Cook with Acre Mortgage and Financial, and I'm making this video to help buyers and maybe agents if they need to help them calculate a mortgage payment with mortgage insurance. And I'm going to show you how to calculate mortgage insurance for FHA, for conventional and certain scenarios, as well as USDA if I have time. So you want to get a full payment, an idea of what your housing payment is going to be on a particular transaction. You might be out on the road, or you might be at your desktop at work and you can't get a hold of anybody and you just want to look on your own. Whatever the case might be, and you're curious and you don't have the ability to reach me, I want to give you the tools and knowledge of how to determine it yourself. And it's also cool to know. So we're going to go to my company's website, acremortgage.com/mortgage-calculators. Or you can just go to acremortgage.com, highlight over this purchase and refinance button, hit mortgage calculators, and it'll take you to this page. All right, and we're going to go over our first example, which is an FHA loan. We're going to plug in some information, which is going to give us our principal and interest portion of our payment, our homeowner's insurance, our property taxes, and our mortgage insurance. Now, mortgage insurance, just so you know, with every different type of loan, whether it be for an FHA loan, a conventional loan, or a USDA loan, mortgage insurance is determined by a percentage or a factor. And whatever that factor is, it's multiplied by the loan amount and divided over a 12-month basis. So whenever you hear anybody in the mortgage world talk about annual mortgage insurance, and I don't know if they refer it that way to clients, but in our world it's referred to as annual mortgage insurance, but it's really paid monthly. So really, if you multiply a loan by whatever the mortgage insurance factor, whether it's private mortgage insurance, whether it's government mortgage insurance, whether it's a guarantee fee for USDA, it's a factor multiplied by the loan amount divided by 12. Okay, and as long as you know that factor, you'll be able to determine mortgage insurance, and you'll see that through the course of the video. So in this scenario, we're going to talk about a $200,000 sales price, which is indicated by the value of the property. We have a $200,000 loan amount, just to make things simple. Okay, in a normal case with an FHA loan, you also pay what's called upfront mortgage insurance, which there's a premium due upfront that most people that use the FHA loan finance in their loan. Okay, it's 1.75% of the amount that you're borrowing. Okay, so if you take $200,000, okay, and you multiply it by 0.0175%, that's going to give you a number. That's $3,500. So technically, if you were borrowing $200,000, and that's your base loan amount is what they call it, then the upfront portion or mortgage insurance premium due to HUD would be $3,500. Most people would borrow that $3,500, so your true loan amount with the mortgage insurance premium would be $203,500. I hope that makes sense. Okay, and not to confuse anybody, we're going to say the purchase price is $200,000, okay, and the loan amount is going to be 96.5%. to make things kind of make sense here. So I was misinforming you a little bit. So we're going to say that the loan amount is, let me just plug this in a system real quick, is going to be $193,000. So what we do is we change this to $193,000. Okay. So and you know what? Let's do the upfront mortgage upfront mortgage insurance calculation too, just so you can understand how to calculate a true FHA payment. So we're going to say $193,000, okay, multiplied by the upfront mortgage insurance factor, which is 0.0175%, okay, and we get $3,377.50. Okay, so we're going to be borrowing $3,377 plus the $200,000 or the $193,000 loan amount. Okay, and we're going to put that in as a total loan amount and give you. Bear with me a second because I just erased my upfront fee. So your total loan amount would be $196,377. The 50 cents would be paid in cash. I don't want to go into a long-winded explanation of why it's got to be paid in cash, but it would be paid in cash. You can't borrow in cents. So our true loan amount with a $200,000 sales price would be $196,377. Okay. So, all right. We have an interest rate of 3.75%, okay, and it's a term of 30 years, which it'll be a 30-year fixed mortgage, okay. Our property taxes, okay, this for some reason on my website is not working properly. I tested this out earlier and it's not calculating the property taxes, but it is calculating information in the property insurance box. So we're going to add both the property taxes and the property insurance in this property insurance box because no matter what, it's all going to the same spot. It's going to what we call an escrow account. So if we're going to say the taxes are $6,000 a year, which translates to $500 a month, and we're going to say that insurance is $1,200 a year, okay, which is $100 a month. And that's a little expensive for homeowners insurance, but this is for example purposes. So if we take our taxes, which are $6,000 a year, and we add our insurance to that, which would be $1,200 a year, we would get $7,200 a year, okay? And we're going to all put that in the insurance box for now until this is fixed, and then you can separate them, but it really doesn't matter. It all adds up in the same spot anyway. And our factor for an FHA loan for maximum financing is going to be 1.35%. HUD, who's the insurer of FHA mortgages, says that any financing for an FHA loan above 95%, okay, anything above 95% is going to give you maximum financing anyway, is going to be 1.35% factor. So you would take your loan amount, multiply it by 1.35%, and divide by 12. Well, this calculator does that all for you. Okay, and if you put your first payment in, let's say you're closing in the month of June, your first payment wouldn't be in June, your first payment would be in August. So we're going to hit the calculate button, and that should give us a breakdown and amortization of our mortgage over the life of 30 years and give us a payment with our mortgage insurance, property taxes, and our principal and interest. And it'll show you in just a second. All right. So, okay, here we have our payment breakdown. All right. So we're going to add this stuff up and make sure it works. But the principal and interest seems to be correct. I'm going to add this up and make sure everything kind of checks out. So you're paying $613 in interest for your first payment, and principal is $295.77. So it comes out to be $909.45, which is right. Great. All right. So our property taxes, like we said, were $100 a month. Okay, for insurance, our property taxes were $500 a month. Okay, which is $600. Okay, and we had $225, or excuse me, $220.92 for mortgage insurance. So everything looks like it added up. I just want to double check that. So we have 196.7 times 0.135 divided by 12. So yes, 220.92 is our mortgage insurance. So great, everything checks out. So you can see, okay, that what your payment is, and you can go down and slide down the scale of your entire mortgage history. This is great, and you know, I don't know if you can print this out, but you might be able to. Yeah, you can print that out. So you can go here, right-click on your mouse and hit print, and it'll give you an amortization schedule and show you how long it will take for your payment to be paid off, and what the corresponding payment is going to give towards principal and interest for each month. The one thing that is guaranteed is that these two numbers added together will not change. So that's a quick and easy way to determine what an FHA payment is, and hopefully understand. And if you don't, you can always reach out to me and I can do it for you. But this is just an informational video to help you understand on your own. If we want to determine a conventional loan, okay, conventional 30-year fixed product, it's a little bit different. And the reason why is because for maximum financing on a conventional loan, it's based off of private mortgage insurance, which means that the mortgage insurance is based off of different factors, and it's not a set insurance. So with FHA, it doesn't really matter what your credit score is, and really it varies very little based on the amount of down payment you have. But in essence, the private mortgage insurance has a lot of more different factors that could affect the amount that you'd pay monthly, and you'll see in just a little bit. So I want to kind of erase all this data and give you another example for a conventional mortgage. Okay, so for a conventional mortgage, we would go to a private mortgage insurance company to use their calculator. I use Radian often for their calculator just because it's easy. It doesn't necessarily mean that I use them all the time for mortgage insurance, and there's no reason that I have to use them for any reason. It's just an easy way for me to calculate an estimate of mortgage insurance for clients. So I go to lenders and go to calculators and rate finder, and I forgot to tell you, go to radian.biz if you want to check out some quotes for private mortgage insurance. And again, your mortgage insurance company would be most likely chosen by whoever you're working with, and so you want to ask them to make sure that they're using the best mortgage insurance company for your loan. If you're getting a conventional loan. So I want to go down to lenders, calculators, rate finder, and I can start plugging in information. The only one that I really want to talk about now is borrower paid monthly mortgage insurance, which has the acronym BPMI, okay? And we're going to do non-refundable, and I don't want to really get into what all this stuff means because it would only be confusing you. So we're only going to check BPMI, and that means borrower paid monthly mortgage insurance, which is pretty much similar to what FHA is offering. They have but they also have an upfront, but they do have that monthly factor, which is 1.35. Conventional loan would only be monthly mortgage insurance, nothing upfront for BPMI. Okay, so if I want to calculate in New Jersey, I can just fill in the information. We're going to say it's a $200,000 loan amount. The maximum financing for a conventional loan is 95% in most cases. So we're going to put 95%. We're going to say the loan term is for 30 years. Okay. In that case, we have a 30% coverage, okay, and it automatically populates the coverage that is required for a 30-year mortgage. The occupancy type, okay, primary residence, we're going to say it's a single-family home. A lot of these things could change the factor or the number or the insurance coverage for a conventional loan, so keep that in mind. We're going to say this is a purchase of a home. Okay, didn't check it for some reason. We're going to say full documentation, and we're going to give the highest credit score bracket for a conventional loan, which is 760 and above. If you go lower than that, you'll see that your factor will change, and DTI stands for debt to income ratio. And we're going to just put 45%. I hit submit, and it brings up my factor, which is 0.54%. So you can see right now at 95%, 5% down, it's a pretty attractive mortgage insurance rate monthly, and you don't have that upfront fee for FHA. So that's an attractable loan in comparison to FHA. The only downside is that you have to come up with 1.5%, but it kind of makes up for how much you have to pay in mortgage insurance as a positive versus FHA. So let's go back to the drawing board and say that the loan amount is $200,000. Okay, actually we're going to say the sales price is $200,000, and we're going to say that the loan amount is $190,000. So sales price $200,000. Interest rate, we're going to say it's a little bit higher. We're going to say it's, oh, what happened here? Oh, sorry about that, guys. I lost you for a second. So we're going to say that the interest rate is 4%, okay, and it's a little bit higher than an FHA loan. And we're going to say that the term is 30 years, and we're going to skip the property tax spot and put everything in the property insurance spot, okay. And it looks like we're going to say that the taxes again are $500 a month, which translates to $6,000 a year, and homeowners insurance is $100 a month, which is $1,200 a year. So we're going to say $7,200 a year, and we're going to say our PMI factor, which we said on this sheet was 0.54%. 0.54%. We hit calculate. Bam, that gives us our payment. Okay, and I'm going to do the double checking again, and this way we can see, you know, the difference, and also give you an idea of how to calculate this payment on your own. So all right, great. So it looks like everything is correct, and again, here you see to your left what the principal portion of your payment is, your interest paid of the payment, your escrows, property taxes, homeowners insurance, and private mortgage insurance gives you a total payment of this. And what your corresponding balance is after every payment made for the duration of the loan. How cool is that? Okay, this is just an easy way for you to determine conventional financing and FHA maximum financing. So both are maximum financing at 95% for conventional, at 96.5% for an FHA loan. We'll do one more loan, and that's USDA. Now USDA, okay, has a factor of 0.4%. I don't believe it's really called mortgage insurance. I think it's called their guarantee fee, and they have an upfront fee as well, okay? And I won't get into that because I want to cut the video short, but you can kind of get an idea of you know, how much your monthly payment will be by just putting in a certain number. So we're gonna do $200,000 loan amount, okay, and we're gonna say the purchase price is $200,000 because USDA allows you to get 100% financing. We're gonna say 3.75% interest, okay, 30-year term, okay. And we're going to say 0.4 is the factor. Now that's the case for any USDA loan, okay? And we're going to keep the taxes the same, all right? So we hit calculate, and bam, okay? So you have your USDA mortgage payment, all right? So we went over, oh, sorry guys. We went over an FHA loan and how to break down a payment with their mortgage insurance and maximum financing, and a conventional loan with a high credit score, the highest credit score that you can have of 760, and broke down that mortgage insurance and a payment monthly, okay, and also a USDA loan. So the USDA loan, the only thing that I haven't really mentioned is that upfront guarantee fee, okay, and you can reach out to me and find out what that is, but this will give you a close idea. The upfront guarantee fee for USDA would be 2% of the 2.04% really of the total amount that you're borrowing, and so this way I can show you a different time or in another video we'll go over that. So if you have any questions, please feel free to comment on the video, reach out to me, inbox me on Facebook. If we're not friends yet, send me a friend request, www.facebook.com/Craig.cook.395. You can reach out to me on my website at www.craigcookloans.com, and hopefully this helped you out. And if you need help with financing, you're looking to purchase a home, you're looking to refinance your home, I am the person to help you out with that. So I will always give you good service, and I will always give you honest and truthful feedback. So please give me a call if you'd like to get more information about doing a loan, and I'll check you out on the next video. Thanks for watching.